Hey, welcome to another video of learning options in 4 minutes or less. And today we're going to look at the concept of a put option. But not only are we going to look at what a put option is and why or in which situations one would use them, but also we're going to give you, as usual, some more practical insight beyond all that, which I think a lot of education out there on options really leave out. So practical stuff, let's have a look at it in 4 minutes or less. So let's start off with our very basic definition, and we are looking at a payoff diagram of a put option. And essentially the put option, the way that it is structured is that you pay a premium and you only make money if the underlying asset that you're betting on, and maybe it's a stock or an index or an ETF or a commodity, actually goes lower. So you have to keep that in mind when you buy a put option. Unless it goes down and ultimately has to go down by more than the premium, you will not make money. You're going to lose money. So basically, just like with call options, anyone that buys a put option and holds it to expiration only has, by definition, historically speaking, a 20% of making money. So you have an 80% chance of losing money, which also gets us to the point of when would you use a put option. So very specifically, you would use a put option to gain leverage. I guess that's the why first. Let's address the why. Just like with call options, you want to expose yourself more to a certain movement and that you think will happen. You're going to buy, let's say, a put option because you want to get more leverage. You make more money with less at risk. But again, keep in mind that the stock or the asset in question does have to move by quite a significant amount, and more or less right now in one direction, meaning lower, for you to make money. So the odds of all those three things coming together, the timing, the magnitude of the move, and the directionality, are actually very low. So just keep that in mind. Now, in terms of the when, you would use a put option very specifically, just like with a call option, if you're looking for a specific catalyst. If there's a catalyst around the corner that you think could move the asset in question materially lower, then you would simply buy a put option. But again, it's important to keep in mind that options are vehicles that are really meant to be traded. So if that move doesn't happen rather soon, you better get out, or what's called roll the option to maybe another month forward or so. And that gets us to the third point. And the third point, I think, is really difficult to understate. To overstate. And that has to do with a lot of people think that you can make bearish bets just like you can make bullish bets. So like if you were to be bullish on an investment or on a company or on a stock, you'd buy the stock and let it go up. And with call options, if you continue to roll them, you could do that as well. But on the short side, when you buy a put, you don't want to be like an investor on the short side. That, historically speaking, has been a losing strategy. So when you buy a put, you have to be even more practical. And this is important. That's a key nugget here. You have to be even more tactical, meaning if it doesn't work out soon, only take a stab and maybe try it again later, but don't continuously try to be bearish. Ultimately, over the long term, that has not been a good strategy. So I hope this is helpful, and we'll see you in the next video of learning options in 4 minutes or less.